Hello, Anna Napoli for the Finance News Network. Joining me from Acorn Capital is Portfolio Manager Rick Squire. Rick, welcome to FNN.
Thanks, Anna. Pleasure to be here.
First up, Rick, could you tell me about Acorn Capital and the investment research capabilities in the resources sector?
Sure. Acorn Capital is a specialist fund manager for emerging Australian companies, and the resources sector forms part of its DNA. Now, the reason I say that is the company's founder, Barry Fairley, was formerly a leading Australian resources analyst and mining executive. And it was through that experience that he recognised that the resources sector was one of the most inefficient parts of the market. By capitalising on that inefficiency, Acorn's resources sector has performed strongly against most of the relevant benchmarks over a range of timeframes. An example of that is that since inception, Acorn's resources portfolio has generated an annualised return of about 11.5% versus 4.8% for the ASX Small Resources Index.
And Rick, the resources super cycle generated great prosperity between around 2000 and 2012. Do you see this event repeating itself again soon?
Yes, certainly the super cycle was a spectacular event. But what investors need to remember is that event was largely driven by the urbanisation of China. Now, that event involved the proportion of the Chinese population living in an urban environment increasing from about 18% in 1980 to nearly 60% today. The resultant construction boom was what drove the super cycle, in particular the demand for iron ore and coking coal used in steel production. Now, looking forward, urbanisation is expected to continue in China, but the country is now entering a phase more of urban consolidation rather than the urban growth that drove the boom earlier this century. So the mix of commodities for the next super cycle will be quite different to the past one.
So Rick, how do investors get exposure to growth commodities versus those associated with urban consolidation in China?
That's a good question. That's one we think a lot about at Acorn. So if you look at the composition of the resources companies comprising the ASX 100, what you see is about 80% of those companies, based on market capitalisation, have the bulk commodities as their principal source of revenue. So that means if an investor is just looking only in that part of the market, they're getting exposure to the commodities that drove the last super cycle. In sharp contrast, if you look at the resources companies that occur outside of the ASX 100 but have a market capitalisation more than about $10 million, we see a very different mix. What we see is companies, about half of those companies have direct exposure to gold, nearly a quarter have exposure to the EV metals. These are the metals like lithium, nickel, cobalt, and the rare earth elements, which are commonly used for the high-strength magnets in electric vehicles. It also provides direct exposure to copper and some of the emerging commodities like potash, which is used in high-quality fertilisers.
As you mentioned, Rick, gold does make up a large proportion of the resources companies outside the ASX 100. Is there any value left in the sector, given it's run so hard since early April this year?
Yes, the last two to 3 months has seen a really strong drive by gold prices. If we just stand back and we look at the fundamentals, they certainly remain strong. Key among that is the Aussie dollar gold price is still up there near all-time highs. And also low oil prices and rising unemployment mean the two key elements of the cost base will also remain low. On a macro scale, we're seeing governments taking on increasing amounts of debt load to stimulate their economies post-COVID-19, and tensions remain, particularly between the US and China and US and Iran.
Rick, electric vehicle metals and copper comprise around a quarter of resources companies outside the ASX 100, but didn't those metals have their boom between 2016 and 2018?
Yeah, they certainly did. But again, for investors, it's important to recognise that that boom was driven by demand from China. So China was so far ahead of the rest of the world in terms of their their use and manufacturing of electric vehicles, that it was their demand that was driving that mini boom. The next boom that we see is the global adoption of these electric vehicles, and this has been mandated by governments around the world. An example of this is that in the UK, that there will be a ban on all new petrol, diesel, and hybrid vehicles from 2040. In fact, that policy comes in place in London from about 2035.
Finally, Rick, what would be the key message you'd like to leave with investors today?
Resources are certainly very cyclical, but for investors to take full advantage of the next upswing, they need a diversified portfolio that's focused on the key growth commodities.
Rick Squire, thank you so much for your insights. We look forward to having you on the network again soon.
Thank you.